Right now, gold is plunging, while the world stands on the brink of geopolitical chaos, and the stock market is setting all-time highs, while massive multi-billion-dollar private funds are practically begging investors to take their money back at a massive discount. Nothing makes sense anymore unless you know exactly where to look. Hello, this is Warm Insight. Today, we're going to talk about global crosscurrents and AI adoption and navigating market inflection points. Leaving a like and subscribing is a huge help to us. Imagine the global market as a vast, unpredictable ocean. Right now, some ships, which represent high-flying tech stocks, are sailing incredibly smoothly on remarkably strong currents, reaching horizons we have never seen before. But at the very same time, other massive vessels representing the private credit markets are completely becalmed. They are dead in the water. The passengers on these stuck ships are so terrified of the deep water that they are entirely hesitant to disembark, even when the captain is offering them a massive discount to get off the boat. Meanwhile, a terrifyingly powerful new engine called artificial intelligence is being forcefully installed on almost every single vessel in the fleet. This new engine promises unprecedented speed and flawless efficiency, but it is also creating incredibly complex new navigational challenges that humanity has never faced. This means that simply following the old maps or relying on traditional weather forecasts will absolutely lead you astray and potentially sink your portfolio. You need to intimately understand the complex interplay of this new technology, the violently shifting geopolitical winds, and the individual, often irrational temperament of the market herd. Let us begin by looking at the deep macroeconomic flow and how geopolitical friction is completely redefining market momentum. For decades, investors relied on a very simple, almost guaranteed mathematical relationship. When global stability was threatened by war or conflict, investors would panic, sell their risky company, stocks, and buy safe haven assets, like gold and silver. This is a behavioral pattern that dates back thousands of years. Think back to the 1970s. During the 1979 Iranian hostage crisis, the geopolitical friction was so intense that fear completely gripped the global financial system. Because of that fear, the price of gold skyrocketed. Investors treated gold as the ultimate universal insurance policy. It was the absolute safest place to hide your wealth when the world seemed to be falling apart. But today we are witnessing a shocking paradox that is completely destroying that historical model. Recently, we have seen a very dangerous and incredibly tense stalemate between the United States and Iran. Geopolitically, the friction in the Middle East is at a boiling point, threatening critical global shipping lanes and energy supplies. By all traditional logic, gold and silver should be rocketing to the moon right now. Instead, we are seeing a significant plunge in precious metal prices. Gold and silver are actively declining, right in the middle of a massive geopolitical standoff. Why is this happening? To understand this, we have to look at how perceived risk is fundamentally shifting. In the modern era, think of investment capital like water flowing down a mountain. It will always take the path of least resistance, toward the highest possible yield. The plunging price of gold tells us that the institutional money, the massive hedge funds and sovereign wealth funds, are no longer looking at global conflict as the ultimate portfolio destroyer. Instead, there is a massive recalibration happening. Capital is fleeing from traditional safe havens and being aggressively redirected into riskier assets, specifically broad market equities and technology stocks. This means the fear of missing out on the massive stock market rally is currently much stronger than the fear of a geopolitical war. Let us look at a real-world example of how smart companies are navigating this exact friction. Take the technology giant Intel. For years, Intel has been caught squarely in the crossfire of the intensely complicated relationship between the United States and China. This is not just a trade war. It is a battle for absolute technological supremacy. Semiconductors, the microscopic chips that power everything from your smartphone to advanced military weaponry, are the new oil. The United States desperately wants to prevent China from accessing the most advanced chip-making technology, and China is fiercely fighting to build its own independent supply chain. Intel sits right in the middle of this high-stakes chess game. In the past, being caught in a geopolitical crossfire like this would absolutely destroy a company's stock price. It is like trying to bake a highly complex, multi-layered wedding cake, but your flour is supplied by a neighbor who actively hates you. and your oven is controlled by a landlord who wants to evict you. But surprisingly, Intel has been aggressively maneuvering through this incredibly hostile environment, and their market valuation has shown remarkable resilience, hitting new highs. This is a profound testament to corporate adaptation. Intel did not just sit there and become a victim of the global trade war. They fundamentally pivoted their supply chains. They heavily leveraged government subsidies, like the CHIPS Act, to build massive new foundries on domestic soil. They engaged in brilliant strategic diplomacy to keep their international operations running. This proves a vital point for modern investors. Geopolitical risk is no longer a monolithic, unstoppable force that automatically destroys value. It is a highly complex variable. If a corporation has agile leadership, they can actually exploit these geopolitical fractures, turning global tension into a massive competitive advantage. But geopolitical tension is only one side of the coin. The absolute dominant force reshaping our world right now is the breathtaking acceleration of artificial intelligence integration. We are not just talking about simple chatbots anymore. We are talking about a foundational re-engineering of the global economy. Look at Amazon. Amazon is aggressively pushing for what they call agentic software. To understand agentic software, you need a simple analogy. Think of standard, traditional software as a very obedient but very unintelligent dog. If you tell the dog to sit, it sits. If you tell it to fetch, it fetches. But it will never do anything unless you give it a direct, highly specific command. Agentic software, on the other hand, is like hiring a highly trained, proactive human butler. You do not need to tell the butler every single micro-step of their job. You just tell the butler to organize a dinner party for 10 people. The butler will independently figure out the menu, buy the groceries, cook the food, set the table, and pour the wine without you ever lifting a finger. Amazon is building AI that can independently execute complex, multi-step business workflows. This is going to completely humanize artificial intelligence and integrate it into the absolute core of global logistics and retail. And to build these incredibly smart digital butlers, technology giants are spending amounts of money that are almost impossible to comprehend. Let us look at Meta, the parent company of Facebook and Instagram. Meta has announced absolutely massive increases in their capital expenditures, specifically dedicated to building artificial intelligence infrastructure. Capital expenditure, or CAPEX, is a financial term for the money a company spends to buy, maintain, or improve its physical assets. Think of it like a bakery deciding to build a massive state-of-the-art, fully automated factory before they have even sold a single loaf of bread from it. They are spending billions of dollars today buying advanced graphic processing units and building colossal data centers, based entirely on the promise of future profits. To truly grasp the scale of what Meta and Amazon are doing, we have to look back at the 1840s in the United Kingdom. During this time, the world experienced something called the railway mania. Investors realized that steam-powered trains were going to completely change the world. So, they poured absolute fortunes into building thousands and thousands of miles of railroad tracks across the entire country. The spending was completely unprecedented. Many of those individual railway companies eventually went totally bankrupt because they spent way too much money too quickly. But the actual physical tracks they built remained in the ground. Those tracks became the foundational infrastructure that powered the entire British Industrial Revolution for the next 100 years. What Meta, Amazon, Microsoft, and Google are doing right now is the exact modern equivalent of the 1840s railway mania. They are laying down the digital tracks for the next century of human progress. They are nearly doubling their capital expenditures. To build this AI infrastructure, this is not just a passing cyclical trend. This is a permanent foundational re-engineering of how human business operates. This is the exact macroeconomic force that is driving the broad equity markets to absolutely ridiculous all-time highs. Investors are making a massive collective bet that this AI-driven innovation will create so much future productivity and so much future profitability that it completely overshadows all other traditional economic concerns. Right now, the market simply does not care about sticky inflation. The market does not care about the trajectory of interest rates. The market only cares about who is going to win the artificial intelligence arms race. But while the stock market is partying like it is the roaring 20s, there is a very dark, very quiet storm brewing in a different part of the financial ocean. We need to talk about collective investor psychology. herd behavior, and the terrifying illiquidity hiding inside the private credit markets. First, let us look at the herd. The herd is currently exhibiting a fascinating and dangerous psychological state. There is an old famous Wall Street maxim that says, "Sell in May and go away." This phrase actually originated in England decades ago. The wealthy aristocrats and bankers would literally sell their stock portfolios in the month of May, leave the hot, dirty city of London, and go to their massive country estates for the entire summer to watch horse racing. Historically, the stock market actually did perform very poorly during the summer months because all the big money managers were on vacation. But right now, in the current market, this deeply ingrained historical warning is being completely and utterly ignored. The herd is aggressively buying stocks at the absolute peak of the market, right as we enter the summer months. Why? Because of a psychological phenomenon known as FOMO, or the fear of missing out. The herd mentality is completely hypnotized by the sustained growth narratives surrounding technology and artificial intelligence. They are looking at the massive gains of companies involved in AI, and they are terrified that if they sell their stocks now, they will miss out on the greatest wealth generation event in human history. The fear of missing out on future profits has become vastly more powerful than the fear of a seasonal market crash. However, this aggressive risk-taking completely disappears. When we look at the private credit sector, what is private credit? Let us use a very simple analogy. Normally, if a mid-sized company wants to build a new warehouse, they go to a large, traditional, highly regulated bank like Chase or Bank of America to get a loan. But sometimes the traditional bank says no because the company is a little too risky. So the company goes to a private group of wealthy investors and institutions who pool their money together to give them the loan instead. That is private credit. It is a massive multi-trillion-dollar shadow banking system that operates largely outside the view of normal regulators. The problem with private credit is that it is highly illiquid. Illiquidity is a complicated financial term, but it essentially means you are trapped. Imagine you take all of your life savings and you buy a beautiful, custom-built 50-room mansion located at the very top of a remote, freezing mountain that has no roads leading to it. Your mansion might technically be worth $20 million on paper, but if you suddenly lose your job and you need cash immediately to buy food, you cannot instantly sell that mansion. It might take you 5 years to find a buyer willing to hike up that mountain. That is illiquidity. You have wealth, but you cannot access it when you need it. Right now, we are seeing massive, glaring warning signs in the private credit market. Recently, a major investment firm called Saba Capital attempted a massive maneuver. There are currently many private credit funds that are struggling because a large number of their investors are getting scared and trying to pull their money out all at once. This is called elevated redemptions. It is basically a slow-motion bank run. Because these private credit funds hold illiquid loans, they do not have the actual cash on hand to pay back all these fleeing investors. So Saba Capital stepped in and offered a tender offer. They basically said to the trapped investors, "We know you want out, and we know your shares are technically worth $100 each. We will buy your shares from you right now in cold, hard cash, but we are only going to pay you $80 a share. We are offering you an escape route, but you have to take a massive 20% loss to use it." Logically, if investors were truly panicking about the underlying health of these loans, they would take the discount and run for their lives. But something incredible happened. There was widespread, almost total disinterest in the tender offer. The investors completely rejected it. This reveals a deeply complex facet of herd behavior. The investors are trapped, they know the assets are highly illiquid, but they absolutely refuse to acknowledge the true market price of their trap. They are terrified of taking a realized loss on their accounting books. They would rather sit in a burning room and pretend the fire does not exist than pay the exit fee to use the fire escape. This widespread aversion to illiquid assets, combined with a total refusal to accurately price risk, is creating a massive systemic pressure cooker. It means that while one part of the market is flying high on AI optimism, another massive multi-trillion-dollar sector is frozen stiff, completely unwilling to function normally. So, what does the truly smart money do? In an incredibly confusing bipolar environment like this is where we shift from the mentality of the herd to the strategy of the contrarian. A contrarian is an investor who actively looks for situations where the absolute vast majority of the public is completely wrong. A contrarian buys winter coats in the middle of a blazing hot July because the coats are incredibly cheap when nobody else wants them, and the contrarian knows with absolute certainty that winter is eventually coming. Let us look at how the smart money is viewing Intel right now. As we discussed earlier, Intel was heavily targeted and severely damaged by early geopolitical trade wars. The herd completely abandoned Intel stock years ago, assuming the company was a dinosaur that could never survive the complexities of the modern global supply chain. But the contrarians looked deeper. They saw the massive government subsidies. They saw the strategic long-term pivot toward domestic manufacturing. They realized that Intel's long-term fundamental value was actually being unlocked by the exact same political landscape that terrified the amateur investors. The smart money bought Intel when it was universally hated, and they are reaping massive rewards. Now that the company has proven its strategic resilience, we can see this exact same contrarian setup happening right now with Meta pre-earnings. Technically speaking, Meta's stock charts look very iffy in the short term. The herd is nervous because Meta is spending absolutely massive historic amounts of money on their artificial intelligence capital expenditures. The amateur investors are worried that this massive spending will hurt Meta's short-term quarterly profits. But the smart money, the contrarians, are completely ignoring the short-term technical indicators. They are looking strictly at the fundamental long-term case. They understand that AI is a generational shift, and that Meta has billions of active daily users to monetize that intelligence. The contrarians view any short-term dip caused by nervous herd mentality as a golden opportunity to violently accumulate more shares. They are focusing strictly on the long-term vision, completely ignoring transient market sentiment. The contrarians are also licking their chops at the terrifying situation in the private credit markets. Remember that tender offer from Saba Capital that everyone rejected? The herd was too scared to buy into the illiquid funds, and the trapped investors were too proud to sell at a loss. But a true contrarian looks at that frozen market and sees massive potential energy. A contrarian institution with a very long investment horizon, perhaps a massive university endowment or a sovereign wealth fund that does not need access to cash for 20 years, might look at those private credit loans and realize they are actually fundamentally sound businesses. The smart money will wait patiently. They will let the elevated redemptions squeeze the private credit funds until the pain becomes absolutely unbearable. And then, when the trapped investors finally break and capitulate out of sheer desperation, the contrarian will swoop in and acquire those deeply undervalued, illiquid assets for pennies on the dollar. They are aggressively taking on the exact illiquidity risk that the herd is desperately running away from because they know they will be massively compensated for their patience once the market sentiment inevitably shifts back to normal. To fully understand this environment, we must build out both the institutional bull case and the institutional bear case. We need to look at the global economy completely objectively, without any emotional bias. Let us begin with the institutional bull. The institutional bull believes with absolute conviction that the global economy is poised for a massive, sustained, multi-year expansion. They base this entire thesis on the accelerating integration of artificial intelligence across absolutely every single industry on the planet. They do not view AI as just a fancy new product to sell. They view it as a fundamental transformation of human labor. Think about a massive law firm that used to employ 500 junior lawyers just to read thousands of boring contracts to look for specific clauses. That process used to take months and cost millions of dollars. Today, an advanced AI system can read, analyze, and flawlessly summarize 100,000 contracts in roughly 45 seconds for a fraction of a penny per document. This is not just a small improvement. This is an unprecedented historic explosion in raw human productivity. The bull case argues that this massive productivity gain will drastically lower corporate costs and violently expand profit margins. Furthermore, the bull points to the fact that current corporate earnings, particularly from the massive technology and innovation leaders, are not just hype. These companies are actually generating staggering amounts of real free cash flow. They are fundamentally sound businesses that are executing brilliant cost management strategies while simultaneously growing their market share. On top of this, the bull points to the incredible resilience of the modern consumer. Despite everyone predicting a terrible recession for the past 2 years, The labor market has remained shockingly strong. People have jobs, their wages are rising, and therefore they are continuing to spend money and fuel the massive engine of economic demand. When you combine this strong consumer with the massive structural investments happening in infrastructure and the multi-trillion-dollar global shift toward green energy, the bull sees a foundation made of solid concrete. Finally, the bull trusts the Federal Reserve. They believe the central bankers are executing a flawless tightrope walk, managing to slowly lower inflation without causing mass unemployment. This incredibly difficult maneuver is known as a soft landing. If the Fed achieves this soft landing, it provides the ultimate constructive backdrop for an absolutely massive stock market rally. Therefore, the bull concludes that all the current market momentum is completely justified, and that we are entering a golden age of continued growth and a highly favorable environment for risk assets. But we cannot be blind. We must flip the coin and deeply analyze the institutional bear case. The bear looks at the exact same global landscape and sees a terrifying house of cards completely ready to collapse at the slightest breeze. The bear sees massive downside risks violently looming on the horizon, threatening to instantly derail the current market optimism. First and foremost, the bear points right back to those geopolitical tensions, particularly in the most critical, highly volatile energy-producing regions of the Middle East and Eastern Europe. The bear understands history. They know that a single, unpredictable spark in the Strait of Hormuz could instantly shut down the global oil supply. If the price of crude oil suddenly violently spikes to $150 a barrel, it will instantly reignite the terrifying fires of global inflation. Every single product that is moved by a truck, a ship, or a plane will become massively more expensive overnight. This would instantly crush consumer demand and shatter the illusion of the soft landing. Secondly, the bear is terrified of the absolute opaque darkness. Inside the private credit markets we discussed earlier, the bear views this illiquid shadow banking system as a massive, ticking time bomb of systemic risk. Unlike traditional banks, which are forced by the government to publicly report their health, private credit funds operate in the shadows. Nobody actually knows exactly how bad the underlying loans really are. If a major economic shock occurs, and those mid-sized companies start defaulting on their high-interest private loans all at once, it could trigger a massive contagion effect. It is like a disease spreading rapidly through an incredibly crowded room. If one massive private credit fund collapses, it could instantly bankrupt the institutions connected to it, dragging the entire financial system down into a terrifying liquidity crisis, reminiscent of the 2008 mortgage meltdown. Furthermore, the bear vehemently disagrees with the bull's view on inflation and the Federal Reserve. The bear looks at the persistent, incredibly sticky core inflation data, specifically the rising costs of housing, insurance, and basic services. The bear believes inflation is absolutely not defeated. Because of this, the central banks will be completely forced to maintain punishingly high interest rates for a much longer period than the herd currently expects. Or worse, the central bank might panic and actually over-tighten the economy by raising rates even further. This aggressive monetary strangulation would absolutely crush corporate profits and ruthlessly push the global economy into a very deep, very painful recession. Finally, the bear looks at the massive concentrated gains in the AI-driven technology sector and sees a textbook, terrifying historical bubble. They look at the insane valuations of companies that are promising the moon, but have not yet delivered sustainable artificial intelligence revenues. The bear compares this directly to the late 1990s dot-com bubble. Back then, any company that simply added .com to the end of their name instantly saw their stock price skyrocket by 500%. Regardless of whether they actually made any money, people quit their jobs to day trade from their living rooms, convinced the internet had changed the fundamental rules of mathematics. We all know how that ended. Trillions of dollars of wealth were violently vaporized in a matter of months. When reality finally set in, the bear warns that the current market is incredibly vulnerable to a similarly sharp, violent correction if these massive AI growth projections fail to materialize exactly as promised, or if global governments suddenly wake up and launch massive regulatory crackdowns on artificial intelligence capabilities. If the herd suddenly loses faith, there will be a massive, chaotic rush for the exit doors, leading to widespread de-risking and a brutal market crash. So, knowing both the incredibly optimistic bull case and the terrifyingly pessimistic bear case, how does the Titan, the master investor, actually construct their playbook? To survive and thrive, the first step in the Titan's playbook is recognizing what we call the generational bargain. Right now, the collective market sentiment is a bizarre, highly toxic chemical mixture. It is leaning extremely heavily towards overwhelming greed, but there is a very palpable, vibrating undercurrent of absolute fear that is keeping every single major institutional investor constantly on edge. The incredibly sustained upward trajectory of the equity markets, which is violently defying all traditional seasonal patterns and completely ignoring massive macroeconomic anxieties, is incredibly indicative of strong, almost religious bullish conviction. This is completely fueled by the manic enthusiasm for artificial intelligence and the objectively robust corporate earnings of the tech giants. But underneath this shiny, exuberant surface, the truly discerning investors harbor deep, terrifying concerns. They are losing sleep over mathematically stretched valuations, the terrifying specter of geopolitical instability in the Middle East and Asia, and the massive, looming potential for a devastating liquidity crunch. In the dark, opaque corners of the private credit market, this creates an incredibly agonizing, highly challenging psychological environment for the investor. Chasing the current market momentum feels incredibly rewarding right now. Every day you wake up, your portfolio is mathematically higher. It releases massive amounts of dopamine into the investor's brain. Yet, the mathematical risk of a sudden, violent portfolio destroying reversal is absolutely ever present. This means you cannot just blindly throw money at the market like a drunken sailor. This environment demands an incredibly highly selective, ruthlessly disciplined approach to capital allocation. This brings us to the second pillar of the Titan's playbook, the asset allocation seesaw. The Titan utilizes a highly specific mathematical framework to balance risk and reward. We call this the 55-35-10 allocation. 55% of the portfolio is aggressively allocated to stocks. But this is not just buying random companies. Deploying capital in this treacherous environment necessitates a highly balanced approach, perfectly blending strategic, high-octane growth with indestructible defensive resilience. You must maintain heavy exposure to the core technology sectors. The Titan does this through massive, highly liquid exchange, traded funds, or ETFs, specifically focused on artificial intelligence, and the absolute bedrock of the modern economy, semiconductors. Think of semiconductors as the modern equivalent of the steel industry. During the building of the massive skyscrapers in the 1920s, you do not need to guess which specific software company will win the AI war. You just buy the companies that manufacture the pickaxes and the shovels for the gold rush. But, to prevent total destruction if the tech bubble pops, the Titan completely balances that aggressive 55% stock allocation with a 35% allocation to ultra-safe assets. You need to heavily diversify into incredibly boring, highly stable sectors that provide consistent, indestructible returns, regardless of what the global economy is doing. This means allocating massive amounts of capital into healthcare and consumer staples. Let us use a simple analogy. If the economy completely collapses tomorrow, people might instantly cancel their Netflix subscriptions. And they definitely will not buy a new $1,000 smartphone. But no matter how bad the economy gets, people will absolutely still buy their heart medication. And they will absolutely still buy toothpaste and toilet paper. Healthcare and consumer staples are defensive fortresses that tend to perform incredibly well during terrifying economic periods. Furthermore, the Titan evaluates traditional industrials to get massive exposure to government infrastructure spending and the massive trend of reshoring supply chains back to domestic soil, which provides a brilliant cyclical hedge against pure, volatile technology reliance. The final piece of the allocation is the 10% held absolutely strictly in cash. Cash is not trash. Cash is a highly strategic, incredibly valuable position. Holding 10% in pure cash gives you the absolute ultimate superpower in investing total optionality if the market suddenly violently crashes by 20%. Because of a geopolitical shock, the investor who is 100% invested in stocks is completely trapped. They can only sit there and watch their wealth burn. But the Titan, sitting on 10% cash, looks at that massive, terrifying market crash not as a tragedy, but as a phenomenal, once-in-a-decade clearance sale. They use that perfectly preserved cash to aggressively buy the absolute best companies in the world at massive, deeply discounted prices. The third pillar of the Titans playbook is constructing the global shield, the massive growing divergence between United States and international market exposure remains an absolutely critical life or death consideration for portfolio construction. Over the past decade, the United States markets, particularly the massive large-cap technology giants, have completely and utterly outperformed the rest of the entire planet. This is largely due to their absolute global leadership in artificial intelligence, innovation, and their shockingly robust, highly protected corporate earnings. However, this incredible strength comes with a massive, dangerous price tag, extremely high valuations. U.S. stocks are mathematically very expensive right now. International markets, on the other hand, represent a massive, deeply complex puzzle. Emerging markets and certain highly developed European economies present potentially massively more attractive valuations. They are mathematically much cheaper. They also provide incredible diversification benefits because they do not always move in the exact same direction as the U.S. stock market. However, they carry vastly higher geopolitical risks and dangerous currency fluctuation risks. A true Titan's strategic allocation involves building a massive, indestructible core position in United States equities, but then brilliantly complementing it with highly selective surgical exposure to international markets that are demonstrating rapidly improving economic fundamentals. The ultimate goal is a highly judicious, carefully constructed mathematical balance, rather than making a completely reckless, all-in casino bet on any single geographic region. The fourth and final pillar of the playbook is mastering survival mechanics. In a terrifying environment characterized by violent, unpredictable macro shifts and the complete unreliability of traditional market maxims, the absolute greatest weapon in your arsenal is dollar cost averaging, or DCA. Dollar cost averaging is an incredibly simple, yet devastatingly effective mathematical tool for risk management. Imagine you have $12,000 to invest. The amateur investor tries to guess the absolute perfect day to invest all $12,000 at once. If they guess wrong and the market crashes the very next day, they are mathematically destroyed and emotionally devastated. The Titan does not guess. The Titan uses dollar cost averaging. They take that $12,000 and they systematically invest exactly $1,000 on the exact same day, every single month, for 12 consecutive months, absolutely, regardless of whether the market is crashing or skyrocketing. It is exactly like slowly and consistently filling up your car's gas tank every week, rather than trying to hoard a year's supply of gasoline in your basement. By investing a fixed amount consistently over time, you completely mitigate the terrifying risk of timing the market incorrectly. When the market goes down, your $1,000 mathematically buys more shares at a discount. When the market goes up, your $1,000 buys fewer shares, but your existing portfolio is growing. It flawlessly smooths out your purchase prices and completely removes human emotion from the equation. Beyond DCA, robust survival mechanics require constantly rebalancing your portfolio. If your tech stocks have a massive historic run and suddenly make up 80% of your portfolio, instead of the planned 55%, you must ruthlessly sell some of those winners and buy more of your safe, boring assets to bring the mathematical ratio back into perfect balance. This forces you to automatically sell high and buy low. To turn all of this complex theory into reality, we have a highly specific VIP action plan. Here is exactly what you should do. Action item 1, initiate a very strategic 5% position in the Global X, robotics and artificial intelligence. ETF, ticker symbol BOTZ, but absolutely, only if the S&P 500 experiences a violent sudden pullback of 5% or more from its recent all-time high. You must aggressively leverage these terrifying market dips to acquire truly innovative world-changing growth companies at a massive mathematical discount. Action item 2, immediately increase your exposure to the utilities. Select sector SPDR fund, ticker symbol XLU, by exactly 3%. If the 10-year United States Treasury yield suddenly drops below 4.0%, this is a highly defensive positioning maneuver that guarantees massive potential for highly stable, utterly reliable dividend income if we enter a lower rate environment. Equally important is what you must absolutely not do. You must ruthlessly avoid the critical, incredibly destructive mistake of chasing the absolutely hottest, most highly speculative technological assets, without deeply understanding their underlying mathematical fundamentals. The powerful, intoxicating psychological allure of massive instant, overnight gains in highly concentrated tech plays can and will lead to absolute permanent capital erosion. If the market sentiment suddenly shifts rapidly, or if these massive AI growth projections prove fundamentally unsustainable, those highly speculative stocks will completely collapse. This makes incredibly disciplined research and highly strict, mathematically sound, risk-adjusted positioning absolutely paramount to your long-term financial survival. Our warm insight for today is this. In times of profound foundational global change, the absolute calmest hand and the clearest, most objective vision will always mathematically outperform the loudest, most panicked voice and the swiftest, most emotional reaction. History repeatedly and ruthlessly shows us that periods of massive, rapid technological advancement, much like the current artificial intelligence revolution, are absolutely always accompanied by intense, completely irrational market speculation, which is then inevitably followed by a violent, terrifying mathematical recalibration. From the absolutely devastating dot-com boom of the late 1990s to the massive, bankrupting railway manias of the 1840s, the only investors who actually survived were the ones who maintained a deeply boring, highly disciplined long-term perspective. They built deeply diversified portfolios, and they ultimately navigated those terrifying inflection points successfully by ruthlessly distinguishing between truly transformative global innovation and completely empty, highly toxic market hype.